Okay, very well. Welcome back. So let us continue with the solving of question 2B. All right. We couldn't finish it. Okay. Okay. For this reason, I want to start all over again to solve the question 2B. All right. Now, now let's go back to the board. Okay. So what we said was that we're using this formula P V. It is equal to A1 divided by 1 plus R raised to power 1 plus A2 divided by 1 plus R raised to power 2 plus A3 divided by 1 plus R raised to power 3 plus and so on till end period, an 1 plus R raised to power divided by 1 plus R raised to power n. So this is how we calculate present values. The one we did in the table that we got 883 is the same thing, or I would have done it this way, I will still get the same thing. So there is a need for us to do it like this so that we'll be able to calculate the variable we are looking for, which is G. Okay, so according to the question, we have the market price of the convertible bond at 960. Then we have coupon at 100 naira. That is coupon for year one divided by 1.12. So R is 12%. That is 0.12 plus 1. That's 1.12 raised to power 1 plus 100 naira in year 2 divided by 1.12 raised to power 2. Now, plus the conversion value, because year 2 is where we will stop, the conversion value. You know, when we are doing something like this, we do redemption value in the final year as well. You have coupon in the final year and you also have redemption value. So conversion value is taking the place of redemption value because we are doing conversion. All right. So, but we don't have the conversion value, but we have the formula, which is PO 1 plus G raised to power n times R divided by 1.12 raised to power 2. So I am going to say raised to power 2 again so that to show that I'm still in year 2. All right. It's just that if we had gotten conversion value, maybe conversion value is, for example, maybe conversion value is 1030. That 1030, I would have added it to the 100 to now be 1130, and I would have put it here, right, in the year 2 in the whole. But but if that is the case, that means we wouldn't have gotten this 960. Maybe that case will be calculating for 960. Okay, so as it is now, so let us fill in. So while we are doing it, still say 960. Let's solve the maths. It is equal to, so let us collapse all these 100 divided by 1.12. That will be 100 divided by 1.12 raised to power 1. I got 89. Let's say 89. Okay. Plus 1 on 1.12 raised to power 2. I got 1.2544. Then I will say 100 divided by that answer. I got 79. So let's say I got 80. 79.7. Let's say approximately 80 plus, what is PO? PO is the current share price in the question. which is 3 naira. Please remember the question we are solving, November 2016, question 2. So this is question 2B. Okay, 3 naira. What is 1 plus growth rate is what we are looking for. We don't have it. N is 2 because it is raised to power 2. Because the option to convert will lapse in 2 years. The conversion ratio is 250. So for every 1,000 shares, you will collect 250. For every 1,000 bond, you collect 250 shares divided by 1.12. That's our DCF, discount factor, raised to power 2, because we are still in year 2. So if I'm going to rewrite this, I'm still going to say 960 equals to 89 plus 80. That's 169 plus 3 times 3 times 250. That's 750. 1 plus G raised to power 1 plus G raised to power 2, all right, divided by 1.12 raised to power 2. Okay, so that is that. So what do we do here? We would collect like times and collect like times. So if we collect like times, it will be 169. We'll cross to the other side. It will be 960 minus 169. Okay, it will be 960 minus 169, which is equal to 750. 1 plus G raised to power 2 divided by 1.12 raised to power 2. Now, 960 minus 169. 960 minus 169. It is equal to 791. Okay, so if I cross multiply it, it will be 791 times 1.12 raised to power 2 equal to 750. 1 plus G raised to power 2. Okay, if I divide both sides by 750, okay, divide both sides by 750, it will be equal to, now this 971 times 1.12 raised to power 2 is what? It gives me 992. I got 992. That is divided by 750, which is equal to 750 cancel 750 here. So I have 1 plus G raised to power 2. Now, how do we do this maths? Okay, from here, let me go to the next slide. Okay, don't let me go. Let me demarcate this page into 2. So from here, what am I going to have? So it's going to be 1 will cross to the other side and become -1. So, and the raised to power 2 will also cross to the other side and become root 992 divided by 750. So therefore, G will now be equal to roots, right? Roots 992 divided by 750 divided by 750, then -1. That is the one with the G is crossing to the other side. So I would say, roots 992 divided by, let me put it in brackets. Okay, root 992 divided by 750, close the bracket. All right. No. Okay, I would say 2. Okay. 2 roots, open bracket, 992 divided by 750 and close the bracket equal to this, all right, minus 1. Okay, so equal to 1.1501, okay, minus 1. Let me say in 3 decimal places, okay, minus 1. That will be equal to 0.150. Therefore, it is times 100 multiplied by 100 to convert it into percentage. Therefore, it is equal to 15%. Okay, G equals to 15, 15%. Okay. Okay. 15G is 15%. Okay. So that is how we calculate things like that. So the implication is that, go back to the question. So they are not saying the recommendation in question C. Say, what recommendation would you make to the holder of the security and why? Okay, the recommendation would be that the holder of security should hold it till option expire if the growth rate is at 15% at least. Okay, so all right, so if not, they should not convert, because the share price will not really will not make it worthwhile if they convert, because if you convert, you're not collecting your money back. So your money is not in share price. So the investments can reduce because share price is reducing. Okay, so I'd say, okay, that is that about that. Okay, and I would also really like to refer you to some other questions, some other ICAN question that speaks to convertible bond. Okay, so it's a diet. Just a minute. The diet is okay. Okay. It's convertible bond. Yeah. So the diet is May 2017. May 2017 question 4. So I would really advise you go over it. May 2017 question 4 speaks about convertible bond. Please look at the answer if you don't know how to solve it, and try to understand the way the answer is. And if you don't understand, you can please chat me up on WhatsApp and ask more questions about that. Please just consider it as an assignment. Please don't forget, I also recommended May 2016 question 3. Please, I recommended that one of the maybe second or third class. Okay. So so basically this would be the end of debt valuation and analysis. However, we are still going to have course to talk about them in another topic. Please, I want to encourage that you just quickly pay attention and watch all these videos and learn and practice, please. And I wish you all the best. In the next video, we'll be talking about cost of capital. Although in this kind of place, we already started talking about cost of capital because we've done cost of debt, and cost of debt is also a kind of cost of capital. So when the next video, in the next class, we'll be talking about weighted average cost of capital, and we'll lay more emphasis on cost of equity. Okay, so in that cost of capital, we still have to talk about cost of debt because it's also part of cost of capital, but we won't really discuss cost of debt like that. We'll just be referring to this class where we discuss cost of debt. So again, in this class, in this debt valuation analysis, we discuss how to value debt, how to know the cost of debt, and we know that market value of debt and cost of debt depends on the classes of the debt, the class it falls in, whether non-traded or traded debt. And I've explained the concept of non-traded and traded debt. And we're saying that we are looking forward to exchange traded. We are considering exchange traded debt. Okay, that's for traded. Okay, and I mentioned how to calculate market value and cost of debt for all of them. And under the traded debt, I discussed that traded debt is divided into two segments, irredeemable and redeemable. We have different formula for calculating cost of debt under these two. All right. For redeemable, it is IRR method. For irredeemable, it is cost of debt interest 1 minus C divided by market price X int. I have explained the principles of market price X int and market price com int. And then I talked about the what is needed to calculate market value of debt and what is needed to calculate cost of debt, which is yield to maturity, which is our IRR. And we discuss duration, and we discuss convertible debt, and with convertible debt we have discussed conversion value. Please go over all the questions we've done. At least we've done like 2 questions, all right, and please go over them now. And for irredeemable and redeemable, all right, I think, can't remember if I mentioned how do you know. Okay, how do you know it is redeemable? Examiner will give you redemption date. Examiner will give you maturity period. When they say, oh, the maturity period is 4 years, that is a redeemable debt. But in a case, or sometimes they will write it like this. They will give you balance sheets. They will give you balance sheet. They will say, oh, balance or statement of financial position as so date 31 December. All right. Then they will now say debenture inside the balance sheet. Debenture, maybe 31 December 2018, for example. Maybe 31 December 2018, for example. They will now say debenture. Inside that debenture, they now put bracket. They now put maybe 2022. Then they put the figure, okay, 500 million. So what they are saying is that the maturity date of this debenture is 2022. That's what they're saying. All right. And you may not see maturity anywhere else again. You understand? Say if the balance sheet is 2018, so the maturity is 2020. So how many years is that? 18, 19, 20, 21, 22. That's 4 years. So please just pay attention to all of these things. That's why I don't like when you are reading the question, you say all figures are to be correct. Okay. The examiner may hide information in the parts you did not read. Okay. So it's just to really be helpful to glance through over everything. But if you try, make sure you try, look. If you cannot see maturity date, then you can assume that such debt is irredeemable debt. But they've not done that before. All the irredeemable debt I kind of set in the past, they always mention it. Or if they don't mention it, they will just say preference shares. And preference shares are always irredeemable. Preference shares, they are irredeemable debts. Okay, they are always irredeemable. All right. So, please, if you watch it and you have any question, please send me message on WhatsApp, or so you can message could be video voice notes, or you type. Just send me a message on WhatsApp. If you need more clarification, please make more research and find more questions which is around depth. So I see you in next class where we'll be talking about weighted average cost of capital. Take care and goodbye. Cheers.